Welcome back to Future You. I have a lot of interesting things to talk about today. And the first most interesting thing is introducing my friend, Andy Fulton. Andy, lots going on in the market last week, rates, all sorts of stuff. What's going on?
Yeah, let's get to it quickly. The Federal Reserve cut federal funds interest rate by a quarter point last Thursday, and that was highly anticipated. It's the first rate cut the Fed's done in over a year. But everybody kind of expected the Fed to cut the interest rates at least a quarter point. Rates had really been coming down for the last 30, 45 days, anticipating a rate cut by the Fed in September. And not only did they cut the Fed funds rate, but they also, the words they say when they cut rates or don't cut rates almost have more impact on the decision to cut rates or not cut rates themselves. And the words that they really used set expectations for investors that we'll probably see 2 or 3 more rate cuts before the end of 2025.
So does that mean everyone should be running out to refinance today?
Well, that depends. Not everybody, right? The last statistic I saw was more than half of American households still have an interest rate below 5.5% on their home right now. If that's likely the case if you bought your home and obtained your mortgage prior to 2022. If you're in that group of people, not yet. What we're quoting in terms of interest rates on refinances today, and not everybody gets the same interest rate. It depends on the program. You might be a veteran, you're using your VA mortgage benefits, they have the best rates. You might be trying to refinance an investment home or a primary home. All those, there's all kinds of factors that go into what interest rate you get quoted and which company you work with, right? Some companies have better rates than others. But I would say in general, we're quoting interest rates on refinances somewhere in the high 5s to the mid 6s right now to most of our clients that are interested. And that should give you a good range of, am I below that? It's not that you just want to be a little bit above that to refinance. You want at least 0.5% savings on an interest rate, if not more, if you're thinking about refinancing. So there are groups of people. If you bought your home after 2022, there's some time periods where rates really kind of spiked up in the last 3 years. I'd say if you're over 6 3/4 or 7% right now, in your current mortgage, raise your hand. Call us. We'll help you. You can even send us a quick email if you're watching this right now at help@future.loans and say, hey, I'm thinking about looking to see if a refinance is worth it to me. We will be very honest and transparent with you. What you need from a professional mortgage broker or loan officer is what's your break-even analysis, because refinances are not free. They do have some cost to them. Even if a company tells you they're free, what they're doing is they're inflating the interest rate they're offering to you in the refinance. So it still needs to be evaluated.
Tell me, when we talk about rates going down, there's stuff that's happened that caused that to occur. What right now are the main things that are being looked at?
Yeah, great question, Andrea. The 2 main things that are being looked at right now are inflation, right? The rise of prices of goods and services in the United States, which has been the main factor for why interest rates got pushed up at the beginning of 2022 and have stayed up until today, right? Inflation really kind of spiraled out of control after the pandemic for all kinds of reasons. Supply chain breaks, increase in demand in certain things from Americans. I mean, it's just been a little bit of a wild ride for the last 5 years. Mm-hmm. But I think inflation's taking a back seat to something else right now that drove the rate drop by the Fed last week, and that is jobs, unemployment rates, job reports. Those right now are a bigger factor in whether the Fed decides to cut rates, and quite honestly, whether people buy or sell 10-year treasuries on the secondary market, because that has a bigger impact on mortgage rates than even the Fed funds rate cut. What I'm showing you here is just the unemployment rate in a percentage on a Fed chart, right? If you've never seen Fed reports before, they're free. They're really good public data coming from our federal government. This is showing the unemployment rate really for more than 75 years of data history in the United States. And if you just look kind of over here, this is where we are today. It looks like, inflation where it is today is not only not bad, it's better than a lot of data points throughout the last 75 years. But we start to kind of zoom in a bit. If you look at the last 5 years of unemployment rates, it really got to good lows, 3.5%, 3.6% unemployment rates through the beginning of 2020 through 22 for the last few years. But you can start to see it climbing a little bit here. And our last report was 4.6% inflation rate. When you go in zooming even closer, we're seeing unemployment go up. We're seeing the jobs created going down. The jobs creation side of the data isn't as reliable. We get a jobs report every month in the United States, and it's based on surveys. And so companies may or may not fill out those surveys. The company surveys they fill out may not be as accurate to what really happened inside those companies. So you keep getting these reiterations of jobs reports from months prior saying, actually, you know what, in May of 2025, we didn't create 300,000 jobs. We actually lost 100,000 jobs. That's not factual of May of 2025, but that's just an example of what we've been hearing for a couple of years now. So I'm not really focused on the jobs report. The jobs report in August came out and said, I think we created 80,000 jobs. We were expecting much more than that. Put the jobs report creation aside because there's a lot of noise in it. The unemployment rate's really what I'm focusing on. And I think the Fed's trying to get ahead of unemployment. They see it rising a little bit. There is, consumer sentiment and general consumer feel in the market as things are very expensive. There's a larger gap between the wealthy and the middle class in today's world, and people really are experiencing several different experiences in the United States of America. Some are doing very, very well. The wealthy are doing better than they were a year ago, and then your middle class is starting to break off into each of its different components. And I think in general, Americans in that middle class area, they have a lot of stress on them right now. They have a lot of stress with finding high-paying jobs. They have a lot of stress in grocery store, in gas, in just, insurance, especially if you're a homeowner. Your homeowner's insurance, especially in the Southeast, has really been driven up just in the last few years from bigger storms. So there's just a lot happening. It's putting a lot of financial pressure on the middle class of the United States. And the Federal Reserve sees that. They're trying to start lowering interest rates because they've had them elevated for quite a period of time to fight inflation. Did all that make sense, Andrea?
It did. It actually made complete sense. But wondering, with AI today, is that impacting the amount of jobs and the jobs report overall?
It's a really good question. Here's the best. Let's use facts, right? So we are starting to see AI commented on in jobs reports. There's two independent reports that came out from JP Morgan Chase and from Goldman Sachs in the last 30 days saying they are seeing more and more impact on AI in certain job markets. It's not impacting all jobs yet, but if very white collar jobs, if you sit down in front of a computer all day long doing computer things, really, really good chance that if you leave your job with your company today, they may not have to replace you with another human being. That's probably the thing we're seeing most in terms of company behaviors is we don't necessarily see companies laying people off because of AI, but as they lose staff, as people find different jobs within the company or move on to different companies, they're not necessarily replacing those jobs with human beings anymore. They're replacing those jobs with AI capabilities. And that the expectation, right, of most employers, CEOs, if you watch CNBC in the morning, the expectation from investors is companies are going to start to see more in more profit because their employment costs are probably going to start coming down gradually and then significantly in the next 3 or 5 years in certain parts of companies because of AI.
Awesome, Andy. Thank you so much for that market update and really just overall jobs update. I think that's super important to understand what's going on with rates. So real estate continues to be an amazing investment for people, but can you talk a little bit about the types of programs out there and really what to look for if you're a real estate investor?
Yeah, let's just talk about the population of real estate investors in general in the United States. It's increasing. Just here's some data points, right? The first quarter of 2025, 1 out of every 4 home was bought by a real estate investor, somebody that was not going to occupy the home as a primary residence. 1 out of every 4. Right? In 2024, 1.2 million homes were bought by investors in the United States of America. 1 out of every 5 homes right now in the United States is owned by somebody that doesn't live in the house as a primary residence. And I think, some people might immediately run to, all right, it's all these big companies that are buying all these properties out there, because that happened. When the pandemic really hit, there was this increase in companies out there that were buying dozens, hundreds, sometimes thousands of homes to create rental property portfolios so that they could take advantage of large platforms that had advanced like VRBO and Airbnb. But that's not necessarily the case. 85% of investor-owned residential properties in the United States are held by individuals that own less than 5 investment properties. But here's what's also interesting. Almost half of landlords in the United States, they own 3 or more properties. So if you become a real estate investor, there's a high probability that, yes, you've got to buy your first one, but that's not going to be the last one to buy. You're more likely to become a multi-residential property investor than just a single residential property investor. And I think all of this is connected, right? When you think about the advancements in AI, the pressure on the middle class in the United States in terms of being employees and the employment pressure on them, the cost pressure in the markets because of inflation, I think a lot of people out there are trying to find other ways to supplement income. I'm going to talk about my own generation. And yes, Andrea, you're in this generation with me, Generation X, right? We're getting into our late 40s, early 50s. We're in the prime earning years of our careers. And, we're one of the first generations that do not have, the benefits that the 20s, 30s, and 40s, what the labor unions really accomplished almost 100 years ago. We're not going to have the pension plans or the retirement funds. We're going to be living off of our 401ks, savings, and IRAs. Those types of assets are really what are going to drive all future generations into, the second parts of their career, retirement, and so on. And I think real estate's going to play a really, really important part of that in the United States because there's only so much real estate, right? There's only so much land. And historically speaking, homes in the United States have performed very, very well for Americans. And so that's why we're starting to see the number of people entering in the residential real estate investment. In fact, there's a lot of news on this recently. Like, right now, if you have, there are certain types of accounts like self-directed IRA accounts that allow, normal Joes like me and you, that if we wanted to maybe instead of invest in the stock market or mutual funds, we could potentially buy residential real estate with a self-directed IRA. That is not the case with 401k plans. You can't do that with a 401k plan. However, there is some activity in Congress to open that up. President Donald Trump is embraced the idea that if you have a 401k plan, you should have the option to buy residential real estate in there for investment purposes. But let's put that aside. Let's just say for whatever reason, maybe you're like me and you want to be able to supplement some passive income in your life and make more than what your job pays you. Owning real estate is one way to do it. And historically speaking, there's been a big barrier to entry in becoming a residential property investor because most of us can't buy them for cash, right? We need to get a mortgage. And the conventional style mortgage programs that have been available in the United States typically require you to put more down payment on an investment property than if you were buying your primary home. I think the standard, more typical minimum down payment on an investment property is 30%. That's a lot of money to come up with at closing to become, to buy your first investment property. The interest rate on those programs is a bit higher because there's a more risk to the investors on that loan. You'd probably walk away from an investment property well before you'd walk away the home that you live and reside in if you got into financial trouble. There's a few others I can talk about, but those are the two main barriers to entry. What I'll say is there's more programs today in the market than there ever has been for residential real estate investment. And I'll point 2 out specifically: fix and flip programs, and then I'll talk about an acronym. It's 4 letters, DSCR, Debt Service Coverage Ratio. Let me talk about fix and flip mortgage programs first. So if you've been a fan of HGTV for the last 10 or 15 years, I think every half hour there's a new fix and flip a show that comes on. We all love them. A lot of people have jumped into fix and flips. They're a lot of work. You got to know what you're doing. There's a lot of risk in fix and flips because what you're generally trying to do is buy something low, fix it up, sell it high, but you're trying to do that in a pretty quick time frame of 6 months to a year, and really not much longer than that. In general, fix and flippers have found private funding, either private investors to help them fund it, or things called hard money loans that can be in interest rates of 12, 15, 17% in times at the market. There are mortgage companies now that offer short-term fix and flip mortgage programs. The rates are somewhere in between what I just described to you in primary home mortgage rates. They're better than what you get in the hard money and private lending world. Mortgage brokers have access to a lot of fix and flip programs out there. along with DSCR programs, debt service coverage ratio. So DSCR programs are more for real estate investors that are looking to buy a home, own it for a very long time, and either short-term rent it through Airbnb or VRBO, or long-term rent it to long-term renters that are part of the community. This is where I live. I'm a long-term rental investor here in my own community, Andrea, and I love doing it. It provides a lot of value to my community in different ways. But in those particular opportunities, the DSCR program comes with two really clear advantages over your more conventional investment programs. One, you don't have to get qualified for your own income to buy an investment property. And that is another big barrier of entry in these types of investments, is you got to borrow money to buy these homes. And you got to have enough income yourself to get approved for your own home, plus the investment property home you're going to buy. And typically it's hard to use potential future income on an investment home because you don't have a history of renting it out, or chances are you likely don't have a renter ready to go when you're buying the house. Some do, and that helps, but most of the times you don't. DSCR programs, that is eliminated because you don't have to be qualified based on the income that you make. The debt to income ratio on a DSCR loan is all completely built around how well that property will do as a rental property. And appraisers typically dictate what they think a house will rent at long-term and both short-term rates. And that's how a DSCR loan is evaluated in terms of the ability to repay. The second thing I would say is an advantage to the DSCR programs is how much you have to put down to buy the home. Most DSCR programs only require you to put 20% down. Yes, it's a significant investment, but quite honestly, you don't want to take much more than an 80% loan on the purchase price of an investment property, because the bigger the loan, the bigger the payment, the more it eats into your cash flow. And you want to have some money saved. You want to have some skin in the game when you're investing in real estate, because the cash flow matters along with the appreciation of the home. Typically, most renters, if they're going to do a DSCR program, they want to see a complete turnaround of their investment in about 8 to 10 years, meaning if a house costs $300,000 as an investment property, you want to earn about $300,000 in that home within the next 8 to 10 years. And that's, the higher a mortgage payment is on that kind of house, the longer it'll take to get the return on your money.
That's such awesome information, Andy. Thank you again so much for keeping us up to date in what's going on in the market and giving us some extra tidbits. Who does not love a DIY show?
Yeah, and I would say, listen, whether you're an experienced real estate investor looking to grow your portfolio, or even you want to evaluate the loans that you have outstanding on some investment properties to see if you're in the money on a refinance, email us. If this is brand new to you, it's something you've been interested in and you don't know the right starting point, and you just want to be able to ask, I'm going to call them stupid questions. You think they're stupid. Like, I just need to ask some stupid questions. I don't know what the hell I'm talking about. There are no stupid questions for us. I know everybody says that, but there really aren't. We will be patient. We'll take our time. We want to teach you everything that we can. Our whole focus as an organization is education on this.
Love it. Please reach out to us. If you have any questions, please share today's podcast, like it, and we will see you again next week. Thanks so much.